Charlie and I are going to give a quick overview of Simplify Managed Futures Strategy ETF, ticker CTA, with a focus on second quarter 2025 performance. Going to highlight some of the current positioning, and then we'll back up a little bit and put that in perspective of some of the year-to-date performance as well. So thanks for tuning in. And we are always available for any follow-up questions. This obviously is not a live webinar, so anytime you guys have questions or want to dig in further, please reach out to Simplify and we'll be happy to set up a call. So before we dive into some of the details on positioning for the quarter, wanted to provide a reminder to everyone as kind of the use case of managed futures in a portfolio and as it relates to some of the historical drawdowns and importance of having a diversifier in the portfolio. Looking back at the tech bubble, the GFC, COVID-19, and the kind of inflationary bear market we saw in 2022, you'll see that as defined by the index, which is the SocGen CTA index in blue, managed futures have really been that ballast in a portfolio alongside stocks as well as bonds even. And so we'll talk about more kind of positioning and how this can be a diversifier within your multi-asset portfolio. Then specifically getting into the Simplify Managed Futures Strategy ETF, highlighting some of the since inception performance and kind of getting the bigger picture of what it means to have a diversifier in the portfolio, but also provide attractive return potential as well. So since inception, we've delivered about 8.33% annualized return. How does that compare to the benchmark index? We've outperformed by almost 9.5% annualized. So yes, that means the index has delivered negative returns since we launched CTA strategy. So really attractive, strong, positive, absolute return. But I think what's more important is we're doing this in the context of also being negatively correlated to those traditional assets in the portfolio, meaning your stocks and your bonds. So about a negative 0.2 correlation to the S&P 500 index and about a negative 0.35 correlation to the Bloomberg US Aggregate Bond Index. The strategy itself is invested in interest rate and commodity markets based here in North America. And I think it's important to think about in the context of, although we are holding commodities, we are in a long short construct. And so the correlation between CTA and the broader Bloomberg Commodity Index is actually about zero as well. So even further diversification if you have a strategic commodity allocation. So wanted to highlight that. And then lastly, a comment that I'll quickly make is kind of going back to that term crisis alpha and what happens when we see negative equity returns. Since inception of this strategy, anytime that the S&P 500 has had a negative monthly return, on average, CTA has provided about a 2.8% positive return. So really important, and you can see how it can be that ballast or that diversifier in times of market stress. So a quick overview of the underlying markets that are held in the strategy at any point in time. You'll see on the far left, we have our interest rate futures. Again, North America centric. So we have US and Canadian rates across their respective curves. And then within commodities, we have exposure across subsectors such as energy, agricultural, metals, as well as livestock. So diversified basket of various markets. We have about 34 pre-approved markets. And some more niche parts of the market as well. And I think that's important as it relates to some of our alpha drivers and the way that we're diversified versus some of our peers in the industry. I mentioned earlier, one of the key objectives of CTA is that it can be a diversifier and a balanced portfolio. So what we're showing here, and I think this is one of the most important visuals as it relates to the importance or objective of this strategy, is the CTA strategy is in white and the orange line is a 60-40 portfolio. And it's, in my opinion, not as important as to which line is above the other, meaning which one's outperformed, but it's the fact that these two are moving in opposite directions at any point in time, meaning you're getting that ballast when your 60-40 is doing really well. CTA and trend following tends to lag, and then vice versa. When your 60-40 is under stress, that's when we see CTA really delivering and providing attractive return for the portfolio. So really important and wanted to put that into perspective. So let's jump right in then to some of the recent performance. I would say on the far left, highlighting some of the longer term perspective, you'll see that per Morningstar in the trend following category, CTA ranks in the first percentile for a trailing 1 year and a trailing 3 year period. We're very proud of this. We've delivered really attractive absolute return. And then for the year-to-date period, we're in about the 35th percentile, and we'll talk about, some of the performance that we gave up in the second quarter despite really strong results in the first quarter, but still really attractive longer-term investment results. And as mentioned, first quarter was strong. We maintained that first percentile rating for the year to date through March 31st. But then in the second quarter, and we'll talk a bit about this, trend following broadly saw a bit of a hiccup, and CTA was not immune to that. So you'll see what I've highlighted here, kind of trying to circle that white line, which is CTA. The first half of this chart is the first quarter, second half is second quarter, and you'll see the CTA index as well. Although it lagged in the first quarter, it also lagged in the second quarter. So year-to-date returns to the end of the second quarter for CTA are negative 2.69%. And then you'll see how that compares to the benchmark, which was about negative 7.9%. So strong outperformance on a relative basis. And then, of course, the 60/40 portfolio. After the tariff pause in early April, we saw a bid for risk assets. And so that 60/40 portfolio has actually done okay year to date, despite the turmoil that we saw earlier in the quarter. So with that, I thought it would be helpful, and I'll bring in Charlie McGarrah, who is the CIO at Altus Partners, who is our futures advisor on this strategy, the brains behind all of the positioning and the model that drives, CTA risk and the underlying contracts that we're holding. So, Charlie, if you wouldn't mind sharing with the audience kind of some high-level takeaways on what drove some of the kind of weakness in performance for the second quarter. And then happy to talk about some of the specific contracts as well.
Yeah. So I think the second quarter has been tough because it's involved a couple of major macro events. The first of which was Liberation Day and the announcement of tariffs, which was highly disruptive to all of capital markets, and in particular involved a re-rating of global growth expectations materially lower. And what that did was it basically pulled the bottom out under the commodity market because the market was anticipating less demand for commodities in aggregate across the world, while at the same time drawing into question perhaps the future flows buying U.S. treasuries and the U.S. Interest rate market. So typically in a portfolio, bonds act as a very natural growth hedge. But this Liberation Day episode in early April of 25 was unique in as much as bonds really underperformed the re-rating of global growth expectations. And I think that caused quite a lot of chaos in portfolios. Subsequent to that, the market recovered quite quickly, partially because of the walkback of the tariff risk and involved a re-rating of global growth higher again. So a very strong reversal, which isn't great for trend and breakout trading. And that's been a pretty unified theme. And as the big, beautiful bill has come into sight with the anticipation that will provide an astronomical amount of fiscal stimulus into the United States of America, growth expectations in the US are, I would say, now quite optimistic again. And so that kind of meaningful down and up kind of framework moved all kind of pretty fast. And that was tough on the trend following sector in general, and in particular made trading interest rates difficult with a fair amount of reversal and a fair amount of stock versus bond dislocation. In commodities, on top of all of that, you've also had the dynamics with the Israeli-Iranian conflict, and that sort of caught the oil market by surprise in May and June as it unfolded. And then also immediately thereafter, peace broke out, and so you had kind of a gap down and then a gap up, and all of those things. Sorry, in oil a gap up and then a gap down. Excuse me, and that also has put a fair amount of discontinuous quick reversal into commodity markets, which has been difficult for trend followers. And that's sort of the story, basically. So turmoil in interest rates and turmoil in commodities with large moves and fast reversals. And that's not great for kind of medium-term trend following, which is why you see the difficulty in the sector of all managed futures year to date, and certainly Simplify's CTA strategy was not immune to that.
Yeah, and I
So
think that's a nice segue also to put this into perspective because I think anytime a strategy or manager has a difficult quarter, there's always things we can point to that help justify. But to really put this into perspective, trend following, if we are looking at the index, which is again the SocGen CTA index, looking back to 1999, which was the inception of the index, 25-year period, this last quarter ending June 30th was the third worst quarter for performance for the index since that 1999 launch. So, really historical event and trend following. And as Charlie alluded to, our strategy was not immune to that. And essentially, if you think about trend following, one of the common pitfalls is that when trends end, it can be really difficult. There's those really extreme whipsaws, reversals in positioning, all of which we saw in both the interest rate and commodity portions of this portfolio in the second quarter. And I think another thing that's important to put into context is the variability of the risk that's being taken in this strategy. So a very unconstrained approach in the sense that we want to take risk when we think the strategy will be rewarded for it, and vice versa. We want to de-risk the portfolio when we don't think there's edge in the signals. And you'll see on this chart here, our strategy is the orange reddish line. The SocGen index is purple. You'll see broadly the trend industry kind of de-risking in the back half of April, and we're kind of finding our footing again. So I think that what that means is kind of coming into this quarter, a lot of trend following is looking for these trends to start picking back up again in various markets. But we won't talk too much about today's positioning. We want to really focus on last quarter, but I do think that's helpful.
yeah, and just to sort of build on that, this is a bit more of a forward-looking view now. In this first 6 months of the year, you have the new administration finding its feet and trying on for size its different aspects of its policy agenda. And the market has been in a dynamic feedback process with that, in certain cases, enabling the administration to pursue its agenda, and in other cases, curtailing its ability to pursue the agenda, most particularly through signal in the bond market. Now that the administration is through getting their giant, big, beautiful bill approved, I think the perception will be on their side. This is just an opinion, but that they have what they need politically now and will likely lean into their flagship policies around immigration, tariffs, industrial policy, and gigantic supply side stimulus through the fiscal channel. So my expectation is that they have what they needed in terms of the legislative agenda now done, and so now we're likely to see the follow through of that. So I would not be surprised. Now, what those trends end up being is an open question. I think beauty is in the eye of the beholder ahead of time around what the possible market impacts are, but I would expect more persistence as the market adjusts to the new policy reality because it's now done.
Yeah.
So I wouldn't be surprised to see extension, whereas earlier this year we saw a lot of noise.
Yep. I hope that happens. Less noise.
I guess we'll see.
Yeah. I think what's also helpful too, we often get asked this question of current positioning may not be reflective of positioning a week ago or a month ago or 6 months ago. And so I think it's helpful just to look at how dynamic the exposure and positioning can be within this strategy. So there's a lot going on this slide. Not going to talk about majority of it, but it's really just to show kind of a heat map, red being the largest negative notional exposures, green being the largest positive notional exposures. And we're showing on the far left interest rates through time, and then on the right, interest rates through time, and then on the left, commodity exposure through time. And you'll see in the since inception, and then by calendar year, and then the quarter to date and year to date period. So maybe just focusing on quarter to date and year to date, we've seen cattle be a key long position in the portfolio for much of the first half of this year. Gold has also been a large notional exposure in the fund, which, as we know, has been quite advantageous with the bid that we've seen in gold year to date with kind of that risk off rally. Natural gas has been kind of a key short position throughout the last quarter. And then broadly, commodity allocations and positionings have been kind of whipsawed. So I'll share on the next slide kind of how some of this exposure has evolved over time. but just wanted to highlight the key short and long positions. And then I would say too, moving to interest rates, some of the short overnight rates in both US and Canada, SOFR and CORA, have predominantly been long through the end of the first quarter for much of the first half of the year. Actually, today, looking at positioning, those short front end rates are quite short. So again, we can see pretty dynamic exposure moving around as the shape of the curve shifts and as kind of the interplay between stocks and bonds might drive our interest rate positioning to either be long or short. So with that being said, maybe just speaking about some of the notional, and I'll let Charlie speak to this in more detail here, but just to explain what we're looking at, this is going back to the beginning of this calendar year. The gold line is our notional exposure within interest rates, and that is on the left-hand axis. And then the blue line is our commodity notional exposure, which is on the right-hand side of this chart. And I wanted to delineate these two because interest rates have lower volatility than commodities for the most part. And so the notional exposure that this fund can take within interest rates can be much greater, positive or negative, than we would be taking within commodities. So, Charlie, if you want to kind of take it away.
Yeah, I think that makes sense. Commodities just have a more volatile price typically than bonds. I think that the kind of thing to note here is the downward trend in the interest rate exposure lately, as the system is getting shorter
Oops,
bond
sorry.
futures in general. And so the system has picked up some view that the combination of positive moves in the equity market and ongoing trend and relative value indicators in rates argue for a short position. And I would expect that to continue for a time.
Yeah, and I would say too, the kind of the takeaway here, right? Interest rates coming into the year negative ultimately saw a pretty strong bid for bonds in the back half of the first quarter with the sell-off in equities. So that's why you see that exposure to interest rates picking up, which then really peaked around the tariff tantrum. And then, as Charlie alluded to, that's been coming down. So kind of a
Yeah.
nice, almost a bell-shaped curve of interest rate exposure, whereas commodities, a lot more fluctuations in either being long or short, which is just, it makes sense given the backdrop
Yeah.
of what we've
And
seen year to date.
yeah, and I would just add that the positive growth expectations embodied in equity market pricing on the back of fiscal stimulus have perhaps unsurprisingly argued for a shorter bias in bonds, because the high growth expectation should generally make interest rates higher.
Yep.
So, and that's reflected in the system at the moment.
And very important point because although CTA is a trend following strategy and trend is a core part of the model that drives positioning, Charlie and his team at Altus Partners have several other robust, diversified indicators that help drive daily positioning. The shape of the curve, the interplay between stock bonds, as we've alluded to here, is actually a really important driver for our fixed income, our
For
interest
sure.
rate positioning in this fund. So a key differentiator as to the investment process behind the strategy. And then maybe we'll just wrap up with a quick snapshot. I don't want to spend too much time here because, again, this is a dynamic strategy. This is as of a point in time. But as we closed out the second quarter, you'll see kind of the exposure across commodities, the long on the far left, the short positions on the right. Again, natural gas, sugar have been some kind of consistent short positions within commodities over the last few months. And then again, lean hogs, live cattle. And we've even started to see copper creep in, which we now know in the last week here, we've seen quite a bit of activity within copper with proposed tariffs and pretty strong rally in copper, which CTA was able to benefit from given a long notional exposure to
Yeah.
that commodity.
And again, I think that the main thing to note here on the right hand side is just the position in bonds is across the entire curve. So, as you might imagine, two-year notes are less volatile than long bonds, and so unsurprisingly, a kind of blended position across the whole curve has a larger notional exposure in twos, but it reflects, I guess, a sort of overall bearish view on all interest rates, i.e., interest rates are going higher, bond prices lower.
Yep.
Would be the view expressed by the system at the moment. I suppose we'll see on how that all turns out. But if the stock market is right that a giant fiscal impulse in the US will drive positive growth, while at the same time tariffs and other types of cross-border trade flows make it harder for international investors to buy US assets, then perhaps the bearish view on the interest rate market will play out.
Great. So I know that was short and sweet. We wanted to just provide high-level overview as well as some of the kind of nuances between positioning and markets and trend following broadly. Again, Charlie is at Altus Partners, which is the futures advisor on CTA. So you'll see him and Steven, the CEO of Altus Partners, listed on this slide here. Both of them are at your disposal for any questions on the model or the process or our partnership. And then you'll see on the left-hand side of this slide the Simplify portfolio management team, additional PMs on the strategy, Dave, Mike, and Ken, and myself. So thank you guys for tuning in, and we'll be back next month with another update. But appreciate your interest and support of CTA.